There's an obvious reason why Supermicro Computer Inc.'s stock price has fallen over 26% in the last 5 days. And this chart on Google Finance does not give you the obvious answer. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. There is a very obvious reason why Supermicro Computer stock price has been dropping. And like I said in the beginning here, it wasn't obvious when you looked at the Google chart. However, a quick glance at FastGraphs gives you the obvious reason. The stock price had a parabolic advance and went way above what earnings justified valuation would be. And now, since that got so extended, the stock has been dropping in the last week, simply moving back into something resembling fair value. But let's analyze this stock using the FastGraph Fundamentals Analyzer software tool. And let's look at the company before it became such a massively overvalued stock. If you look at the company historically, it was a decent growth stock, averaging earnings growth about 11%. And as you can see by this fast graph, there's a blue and an orange line here. The blue line is a PE of 14.8. The orange line is a PE of 15. And that's where the stock traded. It traded up, plus or minus that 14 or 15 PE ratio historically. But then along came artificial intelligence, and Supermicro Computer's earnings began to accelerate dramatically, grew by 128% fiscal year 2022 from 248 to 565, then another 109% by June of 2023, their fiscal year in 23, and it's expected to grow another 85% in 2024. But you can see by this massive parabolic advance here that the stock had got extended, even looking at very high earnings growth that the company was achieving. So now it's coming back into reality. Now we cap the PE ratio. We use the price earnings ratio equal to the growth rate for fast growing companies like this, but we cap it at a 30 multiple. I think it's unrealistic to be using a 67 PE ratio to value this stock. And of course, the stock is beginning to falter. But let's look at the forecasting calculators here, and let's see if we can determine what's really we can expect. The next 2 or 3 years, we would expect about a 32% growth rate. And that, even if you use that P equal to growth rate, we could look at this orange line here. This would give us a 12.5% rate of return over time. But it's not a 32% rate of return, which is what the company should be capable of delivering. If you could buy this somewhere around a 30 multiple, you could expect the rate of return to be about 32%. Now, if you look at long-term growth on this company, analysts reporting to FactSet, which is where we get our estimates from, are expecting a 55.81% average growth rate. Even if I go to the custom calculator and I include the current estimates for the next couple of years and then expand it out, I still get a growth rate of over 45%, and that would give me a 32.93% annualized rate of return. But here's the trick to this, and this is something that investor psychology makes this tough. There is a high probability that this stock could drop by 50% to even as high as 70% over the next couple of years, assuming that it moves down to a more reasonable 30 PE ratio over this area, or even if it traded at a 40 PE ratio or 42 PE ratio, you could make money. But the question is, how much risk are you willing to take? The earnings yield on the stock right now is only 2%, but the forward earnings yield would be much higher. So Supermicro Computer is a leader in AI. We also have Nvidia, which has been another leader in AI that has obviously had this kind of extremely high growth rates here recently. So when you look at Nvidia, you get a similar situation where you had massive increasing growth because of AI, and the stock price, of course, has risen dramatically and continues to rise. Looking at the forecasting calculators using FastGraphs, if we get a 30% plus growth rate going forward, the stock would not be such a great investment unless it continued to trade at a very high price earnings multiple. The long-term growth rate is expected to be 35%. And if you're willing to wait 4 or 5 years, you could make a substantial rate of return holding either one of these two high-quality AI stocks. But the real question is, how much risk are you willing to take? You know, when you're investing in growth stocks, you're dealing with a different animal than normal companies that I often talk about on this channel. These are two really great growth stocks, and they do have amazing potential going forward. But the real question is, achieving the kind of growth that's being expected in these companies is something that a prudent investor, you should be well forewarned that that's an extremely challenging task to continue to grow the business that fast. Right now, there's a lot of optimism on AI, but there's a lot of things that could happen over the next 4 or 5 years for you to be confident that a company can grow at 30, 40, 50% a year going forward. I hope you found this interesting. It clearly shows why, in my opinion, why super microcomputers has been dropping recently. It just simply got ahead of itself. But if you're willing to hold the stock for a long term, who knows? But it takes patience to be a long-term investor in something this risky. Thanks for watching. If you liked the video, give me a like, ring the bell, and take a subscription to FastGraphs, because as I showed you in the beginning here, you can't see what the risk is when you just look at a regular price chart. But when you add fundamentals to the price, it opens your eyes. And as investors, we ought to always be investing with our eyes wide open. Thanks for watching.